Understanding the application of foreign tax credit in corporate tax reduction. Overview of foreign tax credit mechanism. Corporate tax payable in the UAE may be reduced by claiming an available foreign tax credit during the same tax period in which the tax liability arises. The foreign tax credit represents the amount of taxes paid to foreign jurisdictions on income earned from sources outside the UAE, provided that this foreign-sourced income has not been exempted from corporate tax in the UAE. This system of relief is considered unilateral, meaning that it is granted independently by the UAE and does not depend on the existence of a double taxation agreement, DTA, or any reciprocal action from the foreign jurisdiction where the taxes were paid. This structure provides a straightforward way for UAE resident persons to minimize their overall tax burden while conducting business internationally. Conditions for applying the foreign tax credit. To utilize the foreign tax credit, specific conditions must be met. 1. Inclusion of pre-tax foreign income in taxable income. The UAE resident person claiming the credit must include the foreign income, prior to the deduction of foreign taxes, within their overall taxable income for the relevant tax period. This ensures transparency and proper calculation of the corporate tax liability before applying any credit. 2. Calculation of corporate tax liability. The total corporate tax due should first be determined based on the taxable income, including any foreign source income. Once the total tax liability is computed, the foreign tax credit can then be applied as a reduction to the corporate tax payable amount. Limitations on the foreign tax credit. The application of the foreign tax credit is subject to specific limitations to ensure that it does not exceed the tax liability related to foreign source income in the UAE. Credit limit. The amount of the foreign tax credit cannot surpass the amount of corporate tax that would have been payable in the UAE on the foreign income. For example, if the UAE corporate tax rate on the foreign-sourced income results in a lower tax amount than the actual taxes paid abroad, only the lower amount can be credited. The difference between the foreign taxes paid and the applicable UAE corporate tax cannot be claimed or carried forward. No carry forward or refund. Any unutilized portion of the foreign tax credit cannot be carried forward to future tax periods or carried back to previous periods. Additionally, no refunds will be issued for any excess foreign tax credit that cannot be applied. Order of application. The foreign tax credit must be applied after any applicable withholding tax credit has been used to reduce the corporate tax payable. Record-keeping requirements for claiming foreign tax credit. Taxable persons wishing to claim a foreign tax credit must maintain accurate and comprehensive records to substantiate their claims. This may include withholding tax certificates, official documentation demonstrating taxes withheld at source on foreign income, statements of payments or assessments, documents provided by foreign tax authorities outlining the amounts of taxes paid or assessed. Relevant agreements or tax returns, where applicable, supporting agreements or documentation pertaining to the nature of the foreign-sourced income. Maintaining these records ensures compliance and facilitates the accurate application of foreign tax credits. Practical example of foreign tax credit application. Example 36, illustration of foreign tax credit calculation. Scenario. CLLC is a UAE-based company that conducts business through permanent establishments, PACE, in multiple foreign jurisdictions. During a given tax period, CLLC incurs AED 300,000 in foreign taxes on AED 1,500,000 of income earned abroad. CLLC has opted not to exempt this foreign income from UAE taxation. Calculation of corporate tax liability. At the end of the tax period, CLLC's total corporate tax liability in the UAE amounts to AED 1 million. However, CLLC may utilize a foreign tax credit to reduce this liability. The creditable amount is limited to the corporate tax that would have been paid on the foreign income if taxed at the UAE corporate tax rate, calculated as follows. Foreign income, AED 1,500,000. Applicable UAE corporate tax rate, 9%. Maximum foreign tax credit, AED 1,500,000 by 9% is equal to AED 135,000. Since the amount of foreign taxes actually paid, AED 300,000, exceeds the creditable amount, AED 135,000, the surplus AED 165,000 cannot be carried forward, back, or refunded. Therefore, the net corporate tax payable for CLLC is calculated as follows. Initial corporate tax liability, AED 1 million. Applicable foreign tax credit, AED 135,000. Net corporate tax payable, AED 865,000. This calculation ensures that CLLC can effectively reduce its tax burden using the foreign tax credit while adhering to the established limitations, and for more details contact us.